Hi, my name is Griffin Bridgers. I'm an attorney with the law firm of Hutchins & Associates in Denver, Colorado. I'm here today to talk to you about gift tax exclusion reform that could be on the horizon and what you should know about this in terms of how it may affect you or may affect your clients from a legal perspective and from a strategy perspective. As always, I want to remind you that this presentation is not intended to substitute for legal or tax advice, so before taking action based on this information, you should consult with an attorney. Now, right now, there are a set of tax proposals, and the question is, why do they matter? None of these have been enacted as law yet, but the purpose of looking at these proposals in the context of this presentation is because there is a huge risk of overreaction or using the wrong strategy when it comes to potential gift tax reforms. And gifting may be important, especially to use up some gift tax exclusion before it's lost, but the wrong kind of gifting or gifting in the wrong amount could be ineffective. So with that being said, it's important to have some background knowledge before we jump into the actual strategy and proposal itself. So to understand the context of this reform, you should know that every individual has a basic exclusion amount which can be applied as a credit to shield gift tax on transfers during life or estate tax on transfers of wealth at death, or both. And this amount at its current level is $11.7 million. This represents a base of $10 million that's been adjusted for inflation every year since 2011. Now, there's also a separate exclusion of this same amount that's available to offset generation skipping transfer tax as well. That being said, there's another unique feature to the law which you should know to understand the context of proposed reform, and that is what's known as the portability election. What that does is it allows any widow to preserve their deceased spouse's unused basic exclusion. So for example, if you had a spouse who died with $3 million of assets, and those assets were transferred in a way that it used a portion of their $11.7 million basic exclusion as a credit against estate tax. What that means is that that unused balance of $8.7 million could be preserved for their widow. That's accomplished by having the estate of the deceased spouse file an estate tax return to make that election. And then the widow can use both their basic exclusion amount, which is currently $11.7 million, but could be changed by legislative action, and their deceased spouse's unused exclusion, which in this example was $8.7 million and cannot be changed. It's set in stone generally. And the combined total of those two could be used as a credit to offset gift and estate taxes in the future. Now, the big catch here is that this unused exclusion of the deceased spouse cannot be used to offset generation skipping transfer tax. It can only be used to offset gift and estate taxes for transfers by the widow. And it's also important to note that even though Congress can't change that unused exclusion amount, it could be lost if, for example, the widow remarries and becomes widowed again. The widow can only use the unused exclusion of their most recently deceased spouse. So with that being said, here's a quick illustration of what we've talked about so far. So at the top, in the dark green portion of this cylinder, we see the deceased spousal unused exclusion. This is up top because it's used first to offset gift or estate taxes for any transfers by a widow. Now, as I mentioned, this deceased spousal unused exclusion does not apply to generation skipping transfer tax. So a deceased spouse's unused GST tax exemption is lost forever at their death. Now, the deceased spousal unused exclusion is not adjusted for inflation at all. It's a flat amount. However, the widow has a basic exclusion as well. It's currently $11.7 million. It's used last when offsetting gift or estate taxes. And that amount applies to gift and estate tax plus the GST tax as a separate exemption as well. And this amount is subject to exposure to inflation adjustments and exposure to legislative action or sunset of the existing law, which we'll talk about here next. Because The proposed reform acknowledges that the Tax Cuts and Jobs Act of 2017 built in a sunset. That act had the effect of increasing the base amount of the exclusion from 5 million to 10 million, which is the base used to make inflation adjustments since 2011. So what the House Ways and Means Committee has done is it's proposed moving the sunset date from January 1 of 2026 to January 1 of 2022. So originally this base of 10 million was going to be reduced by 1/2 in 2026, but now that could happen in 2022 if this is enacted as law. So, if this is enacted, the new basic exclusion will be a base of $5 million indexed for inflation for every year since 2011, and that should bring it to somewhere around $6 million for 2022 and beyond. But as I mentioned, prior portability elections will not be affected, nor would portability elections after the date of enactment be affected, except that portability would apply to a much smaller exclusion amount that could be preserved. So here's an illustration of the reform. So we see up top, we still have the deceased spousal unused exclusion, which is used first, but we have a red portion. This represents the current exclusion, which is 11.7 million, which could only be effective through December 31 of this year. And then after December 31, if this proposal is enacted, that amount would be reduced by 1/2 to approximately $6 million. So what that means is of these combined exclusions, approximately 5.85 million of exclusion could be lost permanently. And the increased potential gift or estate tax on that amount at a 40% rate would be $2,285,800. So that's significant tax savings that can be achieved if that amount can be used before it is lost. So the apparent action item is to try to use that portion of the exclusion amount before it goes away, and you would need to do so before December 31 of this year. But this is where the issue comes up. You cannot just use a portion of this potentially lost exclusion for a couple reasons. One, what we're going to find out in the next few slides is that any sort of gifting strategy is only effective if the gifted amount essentially exceeds the amount of the exclusion that may be lost, or even the amount of exclusion that may be available at death. And another problem is that, as we looked at on the prior slides and illustrations, if there's any deceased spousal unused exclusion amount, it's deemed to be applied first as a credit against gift or estate tax before the basic exclusion amount is even applied. So your gift should technically use up that entire unused exclusion plus the amount of the basic exclusion that may be lost if you want to make an effective use of this portion of the basic exclusion that may be going away as of December 31. So, to understand why this works, we're going to briefly touch on some portions of this presentation which cover the mechanics of this exclusion and how it's applied as a credit. So there's a credit against gift or estate tax that's applied by plugging in the available exclusion amount at the time of a transfer into the gift and estate tax rate table. And that determines the amount of gift or estate tax that would be payable on a transfer that's equal to that exclusion equivalent. So, in other words, what that does is it effectively exempts from gift or estate tax the first portion of transfers up to that exclusion amount. Now, there's a new Treasury regulation that was enacted last year, which in effect helps you determine what amount of exclusion to plug in to determine this credit. And that amount is the deceased spousal unused exclusion that's available and or actually used for gifts, and then finally the greater of the exclusion that's available at death or the exclusion that's actually used for lifetime gifts. And it's this greater of concept plus the deceased spousal unused exclusion that's going to cause problems when we look at the amount of gift, the minimum effective gift that we must make in order to use the exclusion before it goes away. Now, why do we do this? It's important to note that we're really looking to the amount of exclusion available at death without taking into account any sort of portion of that exclusion that might have been used as a credit against gift tax for lifetime transfers. And that's because what the IRS does is it calculates gift and estate tax on a cumulative basis. So at death, you calculate your estate tax on a base which is equal to the sum of your taxable estate. That's any asset you're treated as owning at death, which is valued at date of death. And then you also have adjusted taxable gifts, which are valued at date of gift. So you use your full exclusion to calculate the credit as if you had waited until death to make the transfers that had been previously made by gift. Now the benefit is the difference in value here. In this adjusted taxable gifts bucket, you use the value at the date of gift. So time value of money and appreciation is ignored. So this slide illustrates the estate tax base, which is the taxable estate, which are any assets you own at death, but valued at their fair market value at your date of death. But then you also have adjusted taxable gifts, which are counted as transfers made at death, but based on the value at the date of the gift. And the effect is that you get to use your full exclusion, whatever amount that might be that's available at death, to offset as a credit the estate tax that would be payable on the combined value of those transfers. And if you actually paid gift tax out of pocket during life, you also get a credit for that amount as well. But essentially what this means is that for any gifts made during life, the post-gift appreciation is not subject to estate tax. The gifted assets are frozen at their date of gift value. Now, the term adjusted means that in some cases, if you gift away assets but retain control or benefit over those assets, then they could be pulled back into your taxable estate as if you own them at death, which means that post-gift appreciation becomes subject to estate tax. So having looked at that in the context of how this credit works, the applicable credit offsets estate tax on both of these buckets, which you should know about. So the credit isn't a flat 40% of the exclusion amount. It's really based on the estate tax rate table, $345,800 of tax on the first $1 million plus 40% of any amount over that first $1 million. So that aside, you don't really need to worry about the calculation. What's more important, as I mentioned a few slides ago, is that your applicable credit is based on your available exclusion at the time of death, which looks to the greater of what's available at death under current law at the time of death, not counting anything that was used for lifetime gifts, or what amount, if greater, was actually used for lifetime gifts. So from that, you can kind of deduce that how this would work out is to mean that if you want to effectively make gifts in order to use the portion of your exclusion which may go away, you have to make lifetime gifts that exceed both the amount of the exclusion that may ultimately be available at death, which is going to be around $6 million, but also you have to predict what inflation adjustments may happen for that $6 million amount between now and the time of your death, and make a gift which exceeds those amounts as well. Now, you still get the benefit of freezing the value of assets in that adjusted taxable gifts bucket, but if your secondary goal or primary goal is to use the exclusion before it goes away, you have to make a very extraordinary gift on an amount that you may not even be able to predict, because there's no way to know how long you'll live, what those inflation adjustments might be, and also to worry about the deceased spousal unused exclusion and whether you even have enough assets to shield a gift that exceeds all of these possible amounts. So it's helpful to think of this summing up in terms of one visual, a formula, which says that if you want to make a gift for the primary purpose of using your gift and estate tax exclusion before it's lost, then any gifts you make between now and December 31 of 2021 must exceed the combined total of these amounts. First, any deceased spousal unused exclusion that you have available right now, plus any amount of your exclusion which may remain after December 31 of 2021, which we estimate to be around $6 million, but plus also any inflation adjustments that may occur with respect to that basic exclusion amount prior to your death, which it's hard to know. But that aside, this kind of lays out the general strategy for gifts between now and December 31 of 2021 and illustrates why it's important not to rush headlong into this, because any gifts which do not exceed the sum of these three amounts on this slide may not be effective for using the portion of the exclusion which may ultimately be lost. So if you enjoyed this presentation and you're interested in hearing more and getting more exclusive content on tax reform, strategies relating thereto, and even client deliverables, you can subscribe to my newsletter at griffinbridgers.substack.com. And I also offer videos like this on my YouTube channel, so if you go to YouTube and search Griffin Bridgers, you'll find a number of videos on various tax and estate planning topics. And if you like this and you have topic suggestions, or if you have questions on this material but not legal or tax advice, you can reach me directly at griffin.bridgers@gmail.com. But thank you for listening to this presentation on gift tax reform and what you should know. And please stay tuned for any content I may have coming down the pike.